Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus, and today we're going to talk a little bit about financial literacy and things that we wished we had known in school that really make a big difference. And I think as doctors, this is often things that are hard to discuss because we're used to being the smart kids. We've talked about this before, and sometimes it's hard to step into an area and go, well, this is basic math, but I don't know it. And maybe I don't know it as well as I should or fully understand what it means. Because every time I come across some of this, it really hits me again like, oh my goodness, this makes a bigger difference than maybe I had given it credit for. So let's dive right in on that. When it comes to financial education, it's really easy to not be educated. Sex ed's required in all 50 states, but only 17 require some sort of financial literacy. And one of the big things that, we're right in the middle of right now, one of the biggest wealth transfers in history, basically, as the baby boomers age and transfer assets to their children, which is mostly the millennials. But what that means is as these assets start moving, there's great opportunities to own things that have been off the market for the last 20, 30 years. And that's what we're finding right now in the commercial real estate space, especially in the small neighborhood retail space. So this is important that this is happening, and it's a great time to be jumping into this space. I'm going to give credit to one of the companies I've been working with is Excelstra. And Excelstra does high-level financial planning, especially for people like physicians. And if you're in the top tax bracket, and we'll soon be bringing him on the show as a sponsor. So I'm not sure where this will line up with that, but it's been so valuable to me. It's something that I want to pass along. And typically, when I was going through some of their educational materials, this just hit me and I was like, wow, this is stuff we should add to the show. So, as we look at our investing, a lot of times we like to feel comfortable doing things that people like us do. And so we tend to move like a herd of sheep, or as my kids are finishing high school, like a herd of teenage girls or investors. We're just all doing what everybody's doing. And it kind of tends to lead us just to do the same thing that everybody else is doing. And typically that's not what's going to get us where we really want to go. If you talk about the 1% in America or the 1% in the world and where that wealth is controlled, those people think differently and they act differently. So if you want to be in a place where you have that type of a lifestyle and you want to let your investments do that for you, you have to start thinking different than everybody else. What does that mean? It means it takes an open mind to learn new material, and it takes guts and courage and knowledge to move forward and take action to do something different, because it's really hard when, if you do something differently than everybody else and it doesn't go well, then you feel like you did this dumb thing by yourself. But if everybody else is doing it, then it doesn't seem quite so scary. Like, oh, well, look, everybody lost their money in this big downturn in the stock market. I'm okay. So what does that mean? From the standpoint of it's a whole mindset thing, and we talk about it a lot. And so if you want to do something different, you're going to have to do something different. Or if you don't want to feel different, you got to find the right people to hang out with and spend your time with so that you're doing the things that those people do. Tony Robbins talks about this. If you hang out with billionaires, you're going to become a billionaire because you're doing the things that they do. And that's just what people do. But if you're hanging out with people who spend their money on things that don't lead to enduring wealth, or, on the worst case, with people who are doing heroin, if you hang out with 5 heroin addicts, chances are you're probably going to act like a heroin addict, even if you don't do heroin. So the point here is you got to make some of these moves on your own, but also you got to start finding a crowd that it makes sense to do this. Okay, so diving into some of these numbers don't lie. So if a person who makes $110,000 a year and they've got $20,000 put away for retirement. Sounds kind of scary. And they're only saving $3,600 a month. What kind of returns do they need to get to that point? When you add up the numbers, it comes out to something like 57%. And they're not going to be ready for retirement until they're 102 years old. So there's only a few ways around this, that you can either invest more or try and get a little bit more money out of your investments. You want to invest like that 1% and make your money work harder for you. So I'd forgot about the rule of 72 until recently. I was going through some stuff with Unicia, and Unicia Pratt, she's been on our show before, and she is the founder of Excelstra. But as we're going through some of this educational stuff, the rule of 72 just makes things make sense. Basically, if you take 72 and divide it by the integer of the percent of your return, it tells you how many years it takes your money to double. So if you're earning 1%, which it wasn't that long ago that we were all earning 1%, it will take 72 years for your money to double. So if you take that 1%, and here's the difference, and this is what interest rates do, especially I'm going to go on a sidetrack here, but everybody loves low interest rates because they look at their house and they're like, oh, look how low my interest rate is. But low interest rates are one of the biggest taxes on the financially illiterate and on people who make less money. And you say, well, why? But their interest rate on their house. Well, here's the difference. If you just put your money in the bank, okay? And because a lot of people aren't making complex investments. So using the rule of 72, if you're earning 1% on your bank account and you put $10,000 away, for that to double, it's going to take 72 years. So to turn your $10,000 into $20,000, 72 years. If you're making 4%, which you can get in the bank now at the time of this recording, in that same 72 years, you're going to turn that $10,000 into almost $169,000. So there is a difference in what happens with those percentages. Now, if you're really trying to change things for yourself, you need to start changing those numbers. And where were those? How do you get those numbers to change? Well, so that same 72 years, if you can get 8% return, that $10,000 turns into over $2.5 million. Now, we don't all have 72 years to make this all work, but that's the power of compounding interest, because you make a little bit more each time, but then when you redo the numbers at your next point where it compounds, you have that much bigger of a number that's compounding. So now we're going to go back to some real numbers, because nobody's really investing for 72 years. But let's say you start investing at 29. So you go to college, you're taking some time getting established in the world before you start putting some money away, because that's where a lot of doctors are at. So if you take that $10,000 and you put that away at age 29, you're starting to make some money here. If you're getting that 4%, which is about what most savings accounts are earning right now, if you play it really well, you might get 5 or a little bit more. But that 4% sitting in that account, when you put that $10,000 in at age 29, will double by about age 47. And by retirement at 64 or 65, you're going to have $40,000. So you'll turn it over 4 times by the time you reach retirement. Well, what if you could get 6% on that money? Here's the difference: is by retirement age, it doubles. Your 10% becomes $20,000 by about the age 40. It becomes $40,000 by your early 50s. It becomes $80,000 at retirement age. So now if we tick that up just a little bit more and we go to 8%, that $10,000 invested at age 29 at 8% compound return will now be $160,000 at retirement. So that is doubled with that 2% increase in return. And this is where, when you start looking at the differences that you can get out of commercial real estate, if we now can just push that up a little bit more to 10%. Now, in a good real estate syndication, 10% annualized return is not a crazy number. This is kind of the base, that usually if we're looking at preferred returns in a syndication, we're looking at that 6 to 8%. 10% is a good pref, but for the full cycle, most everything is looking to go over 10%. Now, as we all know, there's some people having trouble right now, but if you get to 10%, by retirement, you now double that again to $320,000. So going through that again, $10,000 invested at age 29. If you're getting 4% in a savings account at retirement, your $10,000 becomes $40,000. If you get 6%, so a modest return from a syndication, a little bit better than your average in the stock market, but let's call that stock market. At age retirement, your $10,000 becomes $80,000. Now you move up to just 8%. You're in a solid real estate syndication now. Your $10,000 becomes $160,000 at retirement. If you can make those returns even a little bit better and get to 10%, that money doubles again to $320,000. Now, this is the power of compounding interest and investing like the 1% in America. And so often the wealthiest people are not getting crazy returns. They're just making very intentional decisions to move a couple percentage points up the rank. So when we look back, we talked about where do we get these different returns? 4% you can get out of a savings account. I think that's going to be pretty stable long term, that 4 to 6%. Where interest rates are right now, we're pretty much in the 50-year average. There's a lot of people who talk about thinking interest rates are going to go back where you get a mortgage again at 5% and 4%. Those things might happen. I'm not a soothsayer, but we were in extraordinary times when we saw interest rates below 5%. We saw it with the housing collapse back in 2009. I got a mortgage then at 4.25%, which I thought I would never see again in my life. And then with a major global pandemic, we saw 3% and some people even below that. But those aren't your standard interest rates. And so again, if there's any talk out there again about are we looking out for the lower rungs of society versus the elite, low interest rates allow asset prices to rise and turning over assets to make lots of money. A lot of people made a lot of money on real estate while interest rates were 3%. That was not the average working Joe. And so as interest rates go higher, it makes it harder to make those extraordinary returns, but it also makes it easier for the average Joe to make a reasonable return. Does that mean we can't get 10%? I don't think so. It just takes a little more work. But if we look at our different options, besides just putting the money in a bank account, so the stock market.
We'll get back to our show in just a minute, but first I want to offer you an opportunity to accelerate your learning. My life changed and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information, a quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, it'll save you another 1%. I know it's not a lot, but every little bit helps. If you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward.
What is the annual rate of return in the stock market? If we look at the stock market, between 2000 and 2017, And that's picking some pretty high stock market highs in 2017. It went a little higher. The annualized return is just over 4.5%. And that's because, we went from right just after 2000, the stock market got cut about in half. Then it went up 100%. Well, guess what? When you get cut in half, you have to go up 100% to get back to where you were. So by 2008, the stock market between 2002 and 2008, the stock market doubled. But for people who stayed in the market and were there in 2000 to 2008, they got back to where they started from. 2008, the stock market got cut in half again before it started rising, and it's pretty much been rising since 2009. And a lot of that has been due to low interest rates and Fed policy. So over those essentially 20 years, the rate of return was just over 4.5%. When adjusted for inflation, it was only 2.45%. And you can look back and you can go to Google, not Google, or Yahoo Finance was one of my favorite ones for looking at stuff like this, and pick any 20-year period in the stock market and see where that total change was if you put $1,000 or $10,000 in, where it was at the end of that 20-year period. And you don't see a lot of big differences here. You may see, I think the last time I did it, the average returns I saw were slightly higher. They were in the 5 to 7% range, but those higher interest rates typically correlate with a little higher inflation. So again, it's hard to beat 4 to 5% in the stock market when inflation adjusted over time. Now, that would be if you bought an S&P 500 index fund, and you can do that now. You can buy index funds with very low cost ratios. And it's where a lot of people have gone now because they've figured out that that's about the best they're going to do in the stock market. So the biggest thing in the stock market that hurts is losing money. And I think that's in all of our investments. And Warren Buffett's the one who said that, rule number 1 of investing, don't lose money. Rule number 2 of investing, refer to rule number 1. So when we get beyond that S&P 500 index fund, which the low-cost funds, in my opinion, are the most efficient way. But when you get into a lot of money managers that are put into a series of mutual funds, and when I look back at where my 401k spent most of its time for most of my working career was in a managed 401k where we had one of the ones we get that, they're based upon a retirement date. So there's the 2025, the 2035, the 2045. And they're supposed to be adjusting it for risk so it grows more when you're younger, but is more stable when you get older. And they do that. But when you look inside of those, you bought this, this 2035 retirement fund. And what are their management fees on that mutual fund? And they're not that high. They're 1%. Let's just call it 1%. But then you look inside of that fund and it owns another basket of mutual funds. It doesn't own any individual stocks. So then you look at each one of these mutual funds and what are their expense ratios? It may only be 1%. It could be a little higher. It could be lower. It could be 0.1%. But then even some of those mutual funds are another basket of mutual funds. And what happens as you go through these baskets of mutual funds is that you just see the total expense going up to where it can be 5%, 10%. And over time, over that $10,000 we were talking about that was invested at age 29 and runs till age 65, it is not uncommon for your fees to equal your gains. And so the mutual fund industry, and there's data out there, and you can look out there and see it, and there have been some reforms that have been tried to push through, basically skims about $7 trillion off of the top of the returns that people are getting on their investments for managing the whole thing. Now, there's a need for money managers. I'm not saying they're bad people. I'm just saying that if you're a high income earner, there's a better way of doing it and looking a little deeper and knowing a little bit more about what you're doing. There's some different data out there, and I'm going to give this credit again to Excelstra. Here's one model that says, according to the fee model, for a 2-income household where each partner earns the median income for their gender each year over their entire working lifetime, they will pay on average $154,794 in 401k fees. Now, who wouldn't want to have $155,000 back in their bank account? But this gets even worse. If you're a doctor, that's for somebody making the median income. For a high income dual earner household, one where each partner earns an income greater than 3/4 of Americans. So we're only talking being in the top 25%. And a lot of doctors, you're in the top 10% or higher. So if the top 25% on their 401k are going to pay an average of $277,969 or $278,000. What? Who wouldn't want to have that money back? So what are these fees made up when you get into the mutual fund fees? On one side, the simple things, you have trading costs, which include commissions, and also the bid-ask spreads. If most people have traded stocks a little bit, but as you know out there, there's a bid-ask spread where somebody bids one price and somebody's asking another price. But what typically happens is in the companies that are actually handling your transition, when you go online and you order a stock, is they buy it at the lower end of the bid-ask spread and they sell it to you at the higher end. And so that might only be a penny or 0.1 penny, but over the numerous transactions, this is where they make their money and where it adds up. I'm not saying that's a bad thing, but the spot where people get caught on these, where people don't understand where all their money going, is in the expense ratio. This is marketing fees for sales and information packets they send out, administration fees. This is just like healthcare, records, reporting, government regulation. When you have a mutual fund, the amount of regulation that goes in that mutual fund is huge, and that costs money. Just look at hospitals. It's the same thing. And then management fees for doing their research, for the salaries. And I look at some of these and I go, I don't know who they're paying to do this research, because some of these you could build yourself, but they all make it sound like this is pretty important stuff. For me, this was the stuff that finally kicked me over the edge fully into real estate. As I had money in some managed accounts, and they were these baskets of mutual funds. And over a 3-year period, the stock market went up 20% and I made 7%. And so when I look back, I was like, what the heck? Where did my money go? And nobody, when I called the managers, they couldn't give me an explanation, or they wouldn't give me an explanation. And so there's the difference. There's lots of different ways to look at this. There are some products out there that you can get a floor to keep things from going down and allow your now, sometimes you give up some of the highs, but you don't lose money on those. So again, there's one of those key things of just don't lose money. It's the big takeaway out of this whole discussion here is remember that, if we just have our money stuck in stock market averages, typically we're earning less than 5% inflation adjusted. Why are we doing that? Because that's what everybody does. And that way, when we lose money, we feel better because everybody we go to work is complaining about the same thing. They all lost a lot of money. What's scary is if you put your money somewhere else and you lose money when everybody else didn't. That's what we're all scared of. And what's awesome is when you make money when everybody else lost money. And that feels pretty cool, but you can't even brag about it because everybody else is sad at those times. But this is where it comes back. And I think Daniel Kahneman talked about this first, is loss aversion. We are more likely to do things to avoid loss than we are to do things to get gains. And that's why we feel like we're not losing if we lose with everybody else, but the losing stings more if we do it alone. And that's why we tend to just follow the same pathway with everybody else. So the other big part where when you're a high income earner, so that $277,000 in fees that you're giving up over the course of your career in the stock market, the other big one here is taxes. And this is really where I started looking for somebody who could help me more because I kept going to my accountants. I'm like, well, what else can I do? One of my mentors, Ash Patel, he says when he went to his account and they said, well, if you make it, you got to pay it, and a lot of people feel that way, like it's their duty. I don't feel it's my duty to leave it to the government. I'm more than happy to pay what I'm required to. I'm not looking to pay less than I'm legally required to, but I'm not looking to pay a penny more than I'm legally required to. And why? From where I'm standing, the U.S. federal government is one of the most inefficient places for money to go in the entire world. So I would like to keep all that I can. And so the second part of this is not only seeing your money grow, but is the tax planning part. And this is one where really finding somebody who can help you do more than just fill out your taxes. And I spent a long time looking for these people. And again, this episode is all referring back to Excelstra because they were the ones that helped me do more with my tax planning than everybody combined over my entire professional life prior to that. And there's a lot of things that can be done there from a lot of different places, but it takes learning, it takes understanding, and it takes working with a professional to do your tax planning, not just them doing it and you showing up. And that can be the hard part as a doctor, is finding that time, but it's an important thing to do. So if you have any questions about this stuff, or you want to just talk about it, I'm happy to talk to you about it and tell you all the mistakes I've made. Because if I can save somebody from making one stupid mistake that I made, I love that. I love that to know that somebody else didn't have to go through it. You can get in touch with us through our website on surgeonsyndicate.com or go to Fortress Capital, thefortresscapital.com. You can get in touch with us there. Set up a call. We can have a discussion about this. And if you want to talk to some of the people that are helping me make my money do better things, that have what's made my doctor life work optional, we can get you in touch with those people and move your life along too. So I hope this has added some value for you. Thank you for joining us here on Surgeon Syndicate today, and we'll see you next time.
We'll get back to our show in just a minute, but first I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel, and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, it'll save you another 1%. I know it's not a lot, but every little bit helps if you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.